Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're going to be discussing something that you may have heard of by now, but it's actually going to be the demutualization of a very large mutual insurance company. Anthony, what are your thoughts about that?
Well, at first, my thought was I was surprised, right? But one thing I do want to make clear is that this company, Ohio National, we haven't written any whole life with them.
We have not, and that has been intentional,
right?
Would you agree with that?
Yeah, and we did look at them, right? And because if you've seen our content, we typically have 4 criteria when we're looking at an insurance company. First one is they need to be a mutual company.
Yep.
They need to be over 100 years or older. They need to pay dividends every one of those 100 years. And then they need to support the infinite banking concept, right? Ohio National did meet those 4. But, there's another criteria that we just haven't gotten in the weeds on, and that is they need to be highly rated. And one tool that we use is what's called the Comdex rating.
Yeah, the Comdex rating is there's agencies out there that will rank insurance companies based upon financial stability, solvency, and those things. And so the Comdex is really an aggregate of those scores. And what they do is they actually rank them, right? And I've got a quote here. I want to make sure I got it right. But it says that if an insurance company's Comdex ranking is 80, this means that it scores higher than 80% of all other insurance companies with multiple ratings. When I read that, what came to mind was, remember when you take your kid to the pediatrician?
It's been a while.
Right?
Yeah.
But they would measure your kid, and they would always tell you kind of where they fell on the scale of other kids their same age. And so that's really what that Comdex score is. And I remember always taking Declan in there, is they do a measurement, and his body weight was always like in the 20th percentile. But his head was always in the 90th percentile. So we always had this little bobblehead walking around.
It's because he had such a big brain.
Exactly. Genius, like his dad. Right? So today, right, that was a good introduction. But today what we're going to be discussing.
Well, what I would say on that is that for us, we only work with companies that have a Comdex rating of 90 or more.
Awesome. Thanks for sharing that.
Oh, you're welcome. But Ohio National hasn't, I don't know if when they've been up to above 90, but when we looked at them, they were below 90. And in fact, they were kind of dropping.
Yeah.
So you could see that there was some writing on the wall there. But so we just want to ensure that we haven't written any whole life policies with them.
Awesome. Yeah. Great point.
But if you're listening to us, maybe you do have one of those policies. So it's going to be more important for you to listen this, but even if you don't, we're going to provide some good information here.
Absolutely. So today what we're going to talk about is we're going to talk about the difference between stock versus a mutual company. What does it actually mean when a company demutualizes? How and why does this happen? How often this happens? And then also we're going to give you some recommendations and what this actually means for certain policyholders.
Sweet.
Awesome, Anthony. So let's do this. You kind of talked about the Comdex score, but can you share a little bit on the definitions of difference between stock versus mutual?
I mean, to define it is fairly simple, right? It's a company can either be stock or mutual, and it's defined on who the owners are, right? Are they stockholders? Maybe they're traded on the stock exchange, or are they owned mutually by the policyholders? And that's where we get the name mutual company. Now, to us, that's a very big deal. Right? For a few reasons. For one, in our view, any company is there to provide value, not for the customer, but for the owner. Right. So they're going to make decisions that are going to be best for the owner, not what's best for the actual policyholder. And also, when you're a stock company, there's that pressure to hit those quarterly numbers. And to hit those numbers, so they may be tempted to make short-term decisions to prop up their stock price. But a mutual company, they're not traded on the stock exchange, so they don't have that pressure. So what their goal is to make sure the owners, the
Mhm.
policyholders, are going to have the money when they need it most.
Awesome.
But then also being an owner, you get to share the profits.
Mhm.
So we get those profits that come back to the policyholders. And Cameron, what's the tax rate on those again?
0.
Okay, perfect.
Exactly. And then the second topic that we talked about is, what is demutualization? And like Anthony just talked about, it's actually just that process of a mutual company transferring kind of the structure over to a stock company. In essence, what's happening here with Ohio National is there's an outside agency that's coming in and buying that company out, right?
Mm-hmm.
Would you agree with that?
Mm-hmm.
Awesome. Perfect. What else we got?
So Cameron, how and why does something like this happen?
You know, Anthony, you touched on this just a couple minutes ago, is we don't know why, is we can't go in there and look at their books and those things, but we've seen some writing on the wall over the years. And so I was doing some research just on maybe some reasons why this may have happened with Ohio National. And there is one glaring thing that kind of jumps out at you pretty readily if you do some research. This was actually a downgrading. So in those Comdex scores, S&P is a rating agency, and in December of 2020, just recently, they actually wrote a piece where they were downgrading Ohio National. And here's what they had to say is, we have lowered our prospective view of capital and earnings to the BBB confidence level over the next 2 years. We think there's potential volatility in its variable annuity closed block and uncertainties in earnings stemming from the execution of its strategy amid an economic recession. And so, Anthony, there's a lot of fluff in that. Really, what I hear when I read that is that there's a variable annuity, a block of business that Ohio National was doing, and that was a real big anchor onto kind of what was happening in there. And we've seen the writing on the wall, like you mentioned, over the last several years. Ohio National as a company has actually stopped paying commissions and actually stopped servicing that variable annuity business. And so you could kind of see some of the concerns starting to rise 3, 4, 5 years ago.
Mm-hmm.
Awesome. There's also one very particular piece that I'll add to that on the variable annuity part of it is an annuity. Typically, people are buying that to create some sort of income stream. And there's a very specific rider. It's a guaranteed lifetime withdrawal benefit. And in doing the research, what I found is there is what I would say an unfunded liability for that. Mm-hmm. And what that means is somebody could put money into an annuity, and Ohio National as a company was guaranteeing a stream of income as long as they lived. Mm. And what has happened is you got some different things going on, but low interest rates being one of them, and then people may be living longer. But that liability of paying out that income stream was not funded, which means they didn't have the money on hand to be able to pay that. Mm-hmm. And it was a growing kind of unknown liability. And so essentially what they were doing was they were trying to close down that book of business.
Correct. Yeah. Perfect. Cool. Now, Cameron, what about the companies that we write with? You want to share what some of the findings we found?
Yeah, sure. Is what we've reached out to some of the companies that we do work with and that we do recommend, and just looking for clarity on what does make up their kind of book of business. And what we found is we talked to a couple of them. One of the companies actually kind of siloed off certain businesses or certain blocks of business under certain companies. And so I don't know if I want to name any names here, but let's say there's a parent company, and then they had a subsidiary that would only sell IULs. And that same parent company had another subsidiary where they were mainly dealing in whole life insurance. Mm-hmm. And then they had that same parent company had another subsidiary where they're only dealing in final expenses, right? And so that was their way of kind of siloing off certain liabilities in case one of those kind of goes bad, I guess. And so that was one option that we found. And then the other one that we found really doesn't deal really much, hardly at all, with annuities. Very, very small. They do have some annuity business with those types of riders that we see with Ohio National, but it was really just reserved for very few advisors. And so their exposure to that type of risk was minimal.
Perfect.
Yeah. Exactly. Yeah. Awesome. Anthony, what about you? How often does this happen? You and I have been in the business. You've been in there for 10 years. and I've been in it for 10 years in one day.
Okay.
We have not heard about this. How often does this happen, Anthony?
It is very rare, particularly, I mean, extremely rare. I don't even know it's ever happened to one of the top mutual companies.
Yeah.
Right. But because we get this question sometimes, right? You know, when somebody says, well, is my policy FDIC insured? Which I think is an interesting question, because a lot of times people might be putting money probably in the stock market, right? And then what I always say, I don't always say it, but I think it. What's the FDIC insurance on that mutual fund?
Yeah.
Right. So what I think is interesting, people put a more layer of scrutiny to whole life than they do other places that they put their money. Okay. But also, I would say when I got involved with this, I was a little concerned. All right, if it's not FDIC insured, what is the protection? Right. And there's actually quite a few, right? Life insurance companies are very highly regulated, right? And each state has their own regulations. And in fact, each state also has a reserve fund, which could be the equivalent or something equivalent to have an FDIC insurance. But if we were to go back to 2008, the 499 banks went under. Okay, do you know how many mutual companies went under?
0.
Right, 0. Okay, so that kind of shows you, at least when we're comparing it to banks, to the validity of the soundness of these mutual companies. But to me, what I think the most important piece is, in the United States, there's never been a whole life policy that did not pay out. And that's kind of really what it's all about, right? We're concerned, is our money going to be there? Well, you know, this product has been around, particularly in these companies, have been around for some close to 200 years. They've always paid out, right? But what I think is also interesting to know is that when a company does struggle, that there's a lot of options.
Yeah.
Right. Like I mentioned, that reserve fund, right? They could lower dividends. They could lower commissions, expenses. They could merge, or they could do this.
Yep.
But I think a very important piece here is, in this situation, these policyholders are not going to lose money.
Correct.
Right. So we're talking a little bit about how they're going to be compensated. But the key thing to remember is that they're not losing money. And in fact, in the short term, they may even come out ahead.
Yeah.
Right. So, well, actually, one thing we didn't talk about is what happens to these policyholders. Right. So they own part of the company, and then soon they're not. So Cam, how are they compensated?
Yeah. So what's going to happen right here over the next 9 to 12 months is essentially Ohio National is being bought out by this company. And so our advice for anybody that does have one of those policies is don't do anything right now, right? Is we don't know how all this stuff is exactly going to play out. But here in the short term, like Anthony said, is there's a buyout of this company. So somebody else is coming in and buying out Ohio National. And if you own a whole life insurance policy, you are part owner of this company. And so the worst thing, in my opinion, that you could do right now is take or 1035 or move funds from that policy, cancel it anyway, because in the agreement that's been set out so far from the Canadian company that's coming in and buying that is that they're actually coming in with $500 million to buy out the owners. And so as a whole life insurance policy owner, you are the owner. And so you're going to participate in that buyout option. And so that's why Anthony had mentioned in the short term, it could be a benefit for you because they're trying to buy you out and get you out of that contract. And so you could come out ahead. In the long term, though, that is a different point of view, different direction that company is going. And like we just shared with you, we know for a fact that doing infinite banking with a stock company is not in a client's benefit. And so we've got some options that are available to us as far as kind of moving those policies. Maybe some actionable options for somebody. Anthony, do you want to touch on those?
What I would say is so short term, you need to stay in there, see what this buyout, see what or how much that is going to be.
Mm-hmm.
But then after that, I would not want to be I would not have a policy with a stock company.
Mm-hmm.
So the option is that you can roll your cash value from one insurance policy to another with another company. That's called a 1035 tax-free exchange. It's kind of like an IRA rollover, right? Where you have the money, maybe you have it at Fidelity, and then you roll it over to Schwab,
mm-hmm.
right? They just take the money and move it over. In this case, they take that cash value from the old policy and then they dump it into paid up additions in the new one.
It's very similar for those that are in real estate. It's very similar to 1031 in real estate, where you're just taking your gains and your principal from one property and move it into a next.
So long-term wise, I would want a 1035 that policy to a mutual company.
Mm-hmm.
But when we do that, we're going to have to go through underwriting again. So what I would recommend is that you would get convertible term with a mutual company.
Yep.
Right. So at least that way we've locked in your insurability, because it would be terrible for you to wait until this dust all settles and then maybe something happens.
Mm-hmm.
Right. It happens quite a bit where people, I mean, I work on a case right now where a guy got approved last year and then this year he got declined. Right. So that's the advantage of having that convertible term. But there is going to be a cost to that term. But typically, every insurance company has what's called a term conversion credit. And in essence, what they do is they will give you back equivalent to about 1 year's term premium. So if we start thinking about this, if we would anticipate converting this in a year, if we were to get term insurance now, you're going to have to pay the term cost, but when you convert it, you may be able to get a refund of that.
Mm-hmm.
So in essence, really, you might be double coverage for a while, right? And when it's not really costing you anything. But also, if you're at Ohio National, you may have had term because you want to eventually convert it. Now, those term policies do not receive dividends.
Yeah.
So I would look at replacing any term that you had at Ohio National.
Yep.
Anything you want to add to that, Cam?
No, just to give everybody kind of, if you do have a policy with Ohio National, the timeline that everybody's working off of as far as when this thing is fully going to take place would be the end of 2021. And so, like Anthony said, is between now and then, an actionable step that you could take would be looking at securing a term policy with a mutual company that's going to stay mutual, right? That you can then convert once that buyout is over. So hope that helps.
What I would like to add, if you're listening to this, maybe you have an Ohio policy, or maybe you have a policy with another company and not sure if it's set up for infinite banking or not, we'd gladly take a look at it.
Mm-hmm.
A lot of times people don't know what they have.
Yeah.
So we can explain what they have and explain the good and the bad.
Yep. Awesome. If you guys have questions, we'll make sure that we've got a link to our calendar in the show notes, and feel free to reach out to us with any questions.
Go make it a fantastic day.
Take care.